Welcome to Investors Hangout, probably the last episode of the year 2017. 2017, was it a dream year for the equity investors? Did mutual funds do well in relation to their benchmark? We'll discuss all this in today's Investors Hangout with the Managing Director of Value Research, Dhirendra Kumar. This episode is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. My name is Rajesh Lake. I made quite a base for you to discuss with me about the year 2017. What do you think? Was it really a dream year for the investors?
It was a great year.
Okay.
And it was unexpectedly a great year because nobody was anticipating. In fact, many investors waited for the markets to fall, waiting for the correction that, okay, let it fall a bit, then I will invest. There would have been some investors who pulled out their money end of last year, early this year, primarily because they are apprehensive about the market, and the market has gone about proving that it's futile to try and predict the market in the short run. Otherwise too, I think it has been a remarkable year from another perspective, that for the first time, 2017, if one has to classify, characterize this year, democratization of mutual funds has happened. The general curiosity aroused among investors, general public. Otherwise, it has always been a seasonal investment. That people will get excited in a very seasonal way. So in that sense, it has been disappointing for some who were thinking in the old ways, and there are investors who have really taken it to heart. Also, the critical thing that has come that has become very noticeable is that investors are not looking at mutual funds with a very unusual expectation. Mostly in the past, the markets have done very well. Investors' expectations will be raised to a point where they will generally be disappointed. This time round, I find that the kind of fund they have been investing, the scale of SIP, the regularity of it, general investor education. Of course, we are way off from mutual funds. They are still way off from becoming mainstream investments. But I think it has been an outstanding year. Investors have benefited from this, and more investors have invested.
So overall, it's been a year where everyone benefited, as you mentioned. But what about the people who kind of pulled out, which you mentioned? What about them? What should they be doing now? And they're like fence sitters now, waiting, whether the correction will take place, and what will happen. Only when the correction takes place will I jump in. As you very rightly said that you cannot time it. But what should they now do?
One is that focus on what you can actually predict, and you can predict few things. When do you need the money? These things which are in your control. You have absolutely no control on the interest rates, on the global markets, on the Indian markets, the flow of money in the Indian market, the interest rates. So there are a variety of things, and noise will not help you. What will help you is that predicting when do you need the money for your child's education, when do you plan to buy your house, when do you think you will be retiring, do you have a choice, and how much money you are likely to need. And these are pretty simple things to evaluate, and then you can really measure how much time do you have for important goals, how much money you should definitely have, because you know your circumstances best. So creating your contingency fund, creating these medium-term investments or long-term investment, choosing the appropriate fund and get started now. Don't wait for the market to correct. In fact, getting started now, and never invest lump sum. If you are apprehensive about the market, it is a big opportunity loss for anybody to wait and try and time it. So if you are able to do these 3-4 things, manage the controllables, forget about things you can't do anything about, and if you are regular with your plan, your discipline will actually, in fact, if the market corrects, if your hypothesis turns out to be true, then you will benefit, you will buy cheaper. I think, but more importantly, all the people who have got started and, they're about the people who are, what I was saying about the people who are fence sitters. But people who are already invested, it's very important for them to feel happy about it and do nothing. Carry on. And maybe do one more thing, that think in terms of increasing your investments. Because, for your investments to grow, you have to make investments. And the more you invest, more it will grow. So, just thinking in terms of a constant won't help.
I'll come to, you mentioned about lump sum and SIP. I'll come to that in a while. But before that, you used a very nice term for mutual funds being democratized. Would you elaborate a bit on that?
Oh, it's simple. 3 years ago, you had nothing in mutual fund. Today, you have it. Your investments are finding its way into mutual fund. Likewise, in my neighborhood, when I meet people randomly, in the surrounding, everybody is curious. There was a massive campaign run by Amphi, Mutual Fund Sahi Hai. And that has created a great, curiosity among people. It is not trying to sell a product. It is not trying to tell you that this is a large cap fund, because mutual fund product specifically in the past have never been aggressively sold, never in the mass media. So this campaign has aroused a great curiosity. In fact, I have come across, people who it will never cross their mind to make investments. They have come to, seeking help to get started. So that is, that I think is well on its way. And this is discretionary. It is not by any diktat. It is not by any instruction by the government that do this and you will get this incentive, or, this is something you must do, or, there is no incentive plan or tax break. It is entirely voluntary. And it has, it has been provoked by two things. One is that there are great, examples. There are people who can actually tell you that he invested in mutual fund and it's a happy story. They benefited. And the other is that, this, mass media campaign is provoking people to ask more often.
So since we're talking about mutual funds, there has to be something good there. That's why people are, as you very rightly said, the benefit of it.
The benefit of it.
And they've yielded good results out of this. But there's another investment that people are talking about, Bitcoins. And a lot of people are ruining the fact that, oh, perhaps I missed the bus, I should have invested there. And what's your take on that? Mutual funds, Bitcoin, what should we do?
Bitcoin, is based, it's an electronic ledger. It was devised as a currency. And it is not an investment. The characteristic of any investment is that there is something underlying. When you buy the share of a company, then you are the proportionate owner of all the assets.
Correct.
And the future earnings of that company. When you lend it to a company, when you buy the bonds, or when you lend it to the government, or you lend it, your deposit in a bank. So you are effectively lending. So somebody is borrowing money and you are lending money, and he's promising you the return of your capital and the interest at a future date. And with the understanding that he will be investing and he will try and make more money out of it, so that he can actually pay your principal, your capital back on time, and pay you periodic interest. Compared to that, this Bitcoin has nothing underlying. It's an electronic ledger. When you buy it, it moves from your name to somebody else's name. It is something which was, the technology, underlying technology is interesting. It will have relevance, but it will be foolish for somebody. It's a speculation. And it has gotten into a frenzy. If you get into this, perhaps in India, buying Bitcoin is illegal. And if you end up buying it, make sure that you are reporting it and doing something. It's a speculative thing. It was devised as a currency, and unlike all other currency, I can only think of gold as another thing, which is in finite quantity.
Right.
But it has a history of 2,000 years. I don't know, maybe longer. And it is a store of value. Compared to that, Bitcoin is somewhat that, but it has been entirely created by short supply, and nobody's ability to short sell it. Unlike any currency which is backed by a government, it has none of those. So it's an electronic ledger devised as a currency, and buy it at your own risk and peril.
As long as it's illegal, I think we should
I
stay
think
away
one
from
should
it.
should keep away.
Okay. Let's come back to the equity funds. In my opening remark, I mentioned that a lot of equity funds are underperforming from their benchmarks. Is that a reason to worry should we just now leave and sell those and move on to something else? What do you think about the underperformance from the benchmark?
No, this is actually an academic exercise of calculating underperformance, because real life investments don't happen like that.
Okay.
This performance, the lot of funds in 2017 not beating the benchmark, and that too 35%. So it's a debatable thing, but people don't get up in the morning of 1st of January and make their investment and try and look at the value on 31st December and see that, okay, have I defeated the benchmark?
Okay.
People do SIPs, people do accumulation, and they invest for the long run. Anyway, one should not be investing for any period of less than 5 years in equity. So that is not the right way of looking at it. Defeating the benchmark or being beaten by the benchmark or underperforming the benchmark may not be the right yardstick, because if your benchmark goes up by 100% and if you earn 80% return, you have underperformed, but you will still be very happy.
Okay.
And the market goes down by 20% and your fund has gone down by 10%, you will still be unhappy. That's a more realistic way of looking at it. The other thing is that when I do this benchmarking based on a SIP of 3 years or a SIP of 5 years compared to doing a similar SIP in the benchmark, 98% of Indian funds beat the benchmark. So take this message. This is a myth that and because 1 year point to point, buying on 1st of January, selling it on 31st December is not the way to compare it. One should be comparing it, and I think even this benchmark comparison is a futile exercise, because your benchmarks are different. If I am saving money in a balanced fund because I never invested in any market linked investment, I want a steady take on growth, and that is why I chose a vehicle which will be relatively more stable, and then I'm able to achieve my goal in 5 years time or 7 years time or 8 years time.
Correct.
My benchmark should be that. Devise your benchmark. It might be a little difficult. Achieving your goal with a methodical plan and contributing to it is the real is your benchmark. Who does what, and an index which is going up at a certain pace, I don't think it is a very meaningful comparison.
Okay, I'm going to go back to the lump sum and the SIP that we talked about. But just remember what Dhiren said, have your own benchmark. That is extremely important.
Yes.
Right? Okay, in context of 2017.
Just to put a rider to it, goal-linked benchmark. Because if you are able to achieve your goals, that is it. That's your benchmark.
Perfect. Okay, in context of 2017, would it not have been better if I for one, I'm taking my example, put lump sum money into the market, and instead of going SIP route, because 2017, as we discussed, was the dream year after all.
Where was the money before that? That's one way of looking at it. And then people earn, and then people spend, and after that they are left with some saving, and that should be invested. That is why SIP. It fits in with your income cycle, expenditure cycle. That's one. The other thing is that there is a reward or penalty for the discipline that you exercise. Once it gets into your disciplined frame of mind, the problem is that if assuming that on 1st of January last year you had 10 lakh rupees lying somewhere, which means before that it got accumulated, it did not work. That is why, you got some windfall or a bonanza is a different story. That needs to be looked at differently. But for normal people who are earning, spending, and then saving, and then that saving should get invested. For them, it is not wise to accumulate and then invest. Investment should be a process. It should match with your cycle. Then comes, assuming you had that money, then there is a reward or a penalty for the lack of discipline or lack of method. Because assuming that 10 lakh rupee was invested on 1st of January, and there would have been 3 occasions when you saw that market went down by, because markets fall in a brief period, fall very sharply in a brief period of time, and then they go up steadily, the kind of market that we have seen.
Okay.
So, anticipating the Gujarat election, I don't know, last week, the preliminary counting results came in and Congress was leading, and the market went into a tailspin, down by 800 points in the morning. only to close substantially up by evening. But assuming those kind of situations, markets go down by 3%, 4% in a day, that is very unnerving for most investors. The other is that assuming you invested on one, exciting markets are very misleading. This is exactly the kind of situation we were in. Not characteristically it may be different, but in 2017 if somebody got excited, and it was very easy to invest any amount of money at that point in 2007, if you invested in the best performing fund of that year, your money would have eroded completely by nearly 70% in that year, and it would and if you would have held it so far, it would have earned 1% return. Despite a reasonable recovery. I am talking of the best performing fund, money invested lump sum in 2007, holding it for 10 years. And if you would have done a SIP of that same amount, that would have translated into a 8.5% return. And mind you, this is the worst performing Indian equity fund over the last 10 years. So even with the worst performing fund
from 1.5%
from that point to now to 8.5%, and then you would not have lost your sleep, because when you see your 10 lakh rupee getting reduced to 3 lakh rupee, maybe you will be deprived of this market opportunity or this great vehicle for a lifetime. You will never come back again.
Some signs that we have to keep in mind, I mean, continue to invest, but there has to be, we've been discussing that, okay, when the erosion takes place and, from 10 to it coming down to 3%, what are the signs that we must keep in mind that, okay, this is the time that we must systematically get out?
No signs. Because if you are trying to look at signs, then you'll always be misled by some wrong sign. So no sign.
Okay.
Your signs are, when you need the money, prepare beforehand. How much money you need, when, and start preparing it methodically, depending on the quantum. Assuming your child gets into a college, first year fee, you should be in readiness and pull that money out and put it in a bond fund a year before. A year and a half before. Start withdrawing it methodically. You are putting money every month, take it out every month. You should not depend. And then his second year's tuition fee should be withdrawn while he's in the first year. So if you are methodical about it, you will not be overly dependent on the state of the market for your goals. So invest methodically and withdraw methodically.
Okay.
That's the only sign.
Before I take up the questions that our viewers have sent in, any closing remarks on 2017 that you think our viewers must know of, apart from what we have discussed? Is there anything that you want to tell our viewers?
No, I would like to just summarize it. If you haven't got started, get started.
Start now, okay?
If you have been investing, think in terms of increasing it and stick to your plan.
Right.
And if you are trying to, absolutely, lump sum is ruled out when it comes to equity. And if you have been, trying to do this, moving in and out of things, don't do it. If we get into a different kind of state of market, don't try and, get carried by the predictions about the market. Nobody knows.